All right, everybody. Just wanted to welcome everybody here once again. We are now ready to move forward with the free class and the one idea. So I'm going to hand it over to my partner, Mr. Michael Parness, to share with you how to profit from the coming correction.
Okay, so this is correction resurrection, profiting from the coming correction. Basically, we're not representing that your account will or is likely to achieve profits or losses similar to those shown. Past performance is not indicative of future results. Trading is a high-risk endeavor. If you cannot afford to lose, you shouldn't be doing it. And even the best traders like myself lose at times, so be careful. Okay, so trade correctly. This is based on my experience many years in the market, going through several corrections. There are several characteristics that historically play out in any correction in a bear market. One of them is sharp down moves. The market moves a lot faster to the downside than the upside. However, you also get sharp bounces. The market moves a lot faster to the upside on counter trend moves that appear bullish. Obviously, we just had that play out over the last few days or week or so, whereby the market dropped over 2,000 points, almost 3,000 points, I believe. And then it's now rallied, let's see, what, about 1,700 or 1,800 points off those lows on Monday. So those are not normal, typical moves of any stock market. I wish there were. I wish we moved in a, 2,000 point range over the course of every week. We'd be able to make a fortune trading it. But alas, that doesn't happen typically. But we've seen that. And that's because, again, the market historically falls a lot faster than it rises. It took us several years to mount 18,000, and then it took us a few days to pull back all the way to the low 15,000s, right? So it wiped out an entire year of profits plus in a matter of days. And it took, 18 months to get that move to that point, and it took 3 days for us to sell it off. In my experience, the best profits are made selling into rallies rather than pressing at the lows. We again saw that the last 2 days. You don't want to be the last guy holding the bag, right? So when you have a bull market, you're looking to buy high and sell higher. When you have a bear market, you're looking to, in my estimation, the best thing to do is to wait for the rallies and sell into them. So I think actually we'll see how it plays out, but we could be getting very lucky because we've now risen, a good 20% roughly off our lows, or 18%, something like that, off our lows of 2 days ago, which is an insane move again. So we now have an opportunity to potentially sell back into it, and we'll talk about that now. Protecting your capital is your number one priority. It always is as a trader. It's our life's blood. Without capital, we can't trade. There is no money down stock buying, at least that I know of. There are several ways to do that if you're an investor. One of them, okay, if you want to hold your positions, which a lot of analysts recommend, I know a lot of you are straight up investors. You may also trade as well, which is why you're with us. But you still have your IRA, you still want to hold your positions. Well, one thing you can do is write calls against your positions if you wish to hold them long term. If you're like, look, I'm in Apple, I think it's going to go to 250 eventually. It's going to be the first $1 trillion company. I believe in it. I want to own it. I don't want to sell it. Okay, so one of the things you can do is write calls against your positions, and this will generate instant profits for you, and you'll still hold on to your core portfolio. All right, particularly if you are in a choppy, rocky market, you can sell weekly calls, you can sell monthly calls, you can sell leaps against your core position. The other thing you can do is you can buy puts on the market using SPY, DIA, QQQ, or the IWM. For those of you who don't know, SPY is the spiders. It represents the S&P 500. The DIA represents the Dow. The Qs represent the NASDAQ, and IWM represents the Russell 2000. Or if you trade futures, you can short the indexes against your longs as a hedge. Those are the three ways they favor for us. There are other things you can do, but those would be the ones I would do if I had, a large portfolio of stocks, and I just went through, on Monday going, oh my God, my IRA went from $1 million to, 600,000. Well, now that we got this bounce, maybe you want to learn from your mistake of not having any hedge and have a hedge or two. So let's talk about playing the down moves. Okay, sell the rallies, but pick your spots. Typically, when we get counter trend moves, they last 2 to 5 days. I almost never short the first move higher. It takes traders more than a day to cover their shorts and for stubborn institutions to start thinking they are missing the boat. Meaning, oh my God, you mean the market isn't going to zero? I need to buy or else I'm going to miss the move higher. Okay? So that creates what we call short squeezes. The other thing I like to do is leg into shorts or puts rather than trying to pick the rally top. I suggest a quarter to a third share lots and adding if it goes against you. If it goes your way, it means you make money. You just don't get the biggest payoff. How do you get your biggest payoff? Well, you have to get a little lucky. If you start off wrong and too early and you fill your whole position, meaning you add and then you add again, and then obviously set a stop in case we're just completely wrong and the market goes to new highs. And then were you to do that and we were to backslide, that's how you make your most money. And I've done that several times, but it doesn't, it's not a perfect, there's no way to time a top. There's the same way there's no way to time a bottom. Look at relative strength and weakness and stocks that have a high short interest that have had bigger than normal moves higher, squeezes, but were in downtrends prior to the correction. Okay, this is important. We want to find stocks when we're looking to reshort the market, right, on moves higher. We want to find stocks that before there was a correction, they were weak. And the correction just meant that those probably heavily shorted stocks got an extended move to the upside and are very likely to resume their downside move because, hell, they were going down even when the market was going up. Look for these types to resume their downtrend, downward bias, and underperform once past the bounce moves. The reason they were stuck in a severe downtrend wasn't the bear market move. And they often get a ridiculous move higher, as I said, on no news, because shorts scramble to cover them, creating massive squeezes. Watch ranges for breaks and resistance. Also watch whole numbers. Right now, again, I think the timing of this class couldn't be better. We'll see if that turns out to be true. I mean, what do I know? Maybe, there's an off chance that we go back to the highs right now, right? We just rallied 3,000 points off the lows of 3 days ago, and, everybody's elated again. But right now, we're ready. If we gap up tomorrow, which I'm hoping, I think Mike talked a little bit about this, but the best for me, in my mind, would be the S&P hitting 2,000. It might overshoot it. It might hit 2010, 2005. But that, for me, would be a great place for me to start laying into some shorts again. Or the NASDAQ 5,000, for example. Again, we want to look for round number, whole number resistance levels. To me, that's usually those are the lines where oftentimes the rallies gyrate there and then surpass briefly, as I said, before falling back if when unable to penetrate them to the upside. Okay? So, the fact is the S&P closed today at, I think, 1987 or thereabouts, or at least it was after hours. I don't know what it is right now. But that is, to me, that's like a great marker. I would love for us to see 2000, like I said, even 2010, even 2020, before the end of the month. And I think that would make a great entry to start laying on some put positions. Even if we were to resume our upside move and hey, this was just a minor correction and we're just going to go back to the highs and surpass them. Even if that's the case, we should get a pullback around the 2000 level. I'd say within 10%. So that's 2020 on the upside would be where I would think would be the absolute peak of this move. And that's still about 33 points away, which is a decent move in and of itself. But the last 2 days, we surpassed that kind of move. So again, tomorrow I'd love to see another move like today. And that's when I think you can start laying on your third position. I'd even say lay on a half a position on that break to the upside over 2000. I think you can lay on half your positions, half size positions, and then we can add around 2050 if it were to get a move there. And then you have to stop out. If we start motoring and, we break to the upside through the range which to me means more than 10%, a little over 10% past the range, which I'll talk about in a minute, then that's where I want to look to enter my positions. Before that, if we were to break to the upside and it negates the downside move we've just had, then I want to look at it and go, okay, I got to stop out. But the good thing about this trade is you define your risk. Playing the bounces. Wait for clear signals of a reversal. Typically, the only move that matters for a bullish counter trend move is the one that happens end of day. It's one thing to rally in the morning, But if the market can close at its high, there is a high likelihood that we continue higher the next day or even for a few days. End of day is key for clear signals of market momentum. Early in the day, the market typically will chop around after the first reversal day. It's typically not a straight shot higher, particularly once you hit those key resistance levels. So if you look at the last 2 days, this is a perfect, or 3 days actually, this is a perfect example. So on Tuesday, right, Monday we had the huge down move. We bounced, we closed, about halfway between the lows of down 1,000, closed down 500 and change. Tuesday, they tried to rally us, right? In the morning, the market was up. It's like, oh my God, look, everybody's buying. Market was up 400 points at one point, I believe. And then into the close, not only did it give up whatever amount of hundreds of points that we were up, but we ended up finishing down 200 points. So what did that tell me? Well, that told me that we weren't quite ready to bounce, at least on Tuesday. Wednesday, however, was different, right? We opened high. We opened, up decently. And then into the close, we continued higher and higher and higher. And then we closed up some 600 points, which is unheard of, right? So Tuesday, they couldn't wait to sell us. But then Wednesday, they were like, oh my God, I think we're at a bottom. I need to start buying. And there was a rush, a stampede to buy. Now, off yesterday's action, today made perfect sense to me. I thought we would gap up. I thought at some point we would fade, like Mike said, and I thought we would close at our highs. Because again, remember, covering shorts or the institutions who are now thinking, oh my God, I might have missed the bottom, they're all rushing to cash in. They want to get into the market, right? And see, the thing about it is, one thing that I've learned over the years is that when the market is going to correct and if it goes into a bear market and stays there, well, one thing you can be sure of, it will maximize the pain that people suffer. It will maximize the pain. So these kind of rallies then become head fakes, and you have all these people piling in, taking their money off the sidelines. Oh my God. But you see how illogical it is, because everybody's saying, wow, Facebook is a great buy on this dip. What dip? Facebook's $90. It's down less than 10% or 10% from its highs. That's not a correction. That's nothing, right? Amazon was in full-blown sell mode before this happened. It's right back where it was right before the correction. So what correction? Yeah, there are stocks like Disney, but Disney had poor earnings. So it was headed that way anyways. But if you look at like a lot of the stocks that supposedly are now great buys, they're barely off their highs of the year. They're barely off them. Amazon, FANG, Facebook, Amazon, Apple, they're not far from their highs. They're all within 10% of their highs. So what great bargains is anybody really getting? Netflix is a great buy at 117. It was a great buy at 92. At 117, I really want to pile into it if I want to go long. Not so much in my mind. So, it takes more than a day, though, for that to sort itself out. Shorts have to cover, and the guys who missed the boat in the first place or who were scared and jumped out at 92, now they want to get back in and at 117 on Netflix. Trust me, I guarantee there are lots of guys, lots of fund managers who bailed at the open Monday, panic sold because there was a lot of institutional selling, and they're rebuying 15% higher or 20% higher in the case of Netflix. A guarantee. Because they're not the smartest kids in the classroom. They're not smarter than a fifth grader or even a third grader. Playing the market either way. Price action is everything. Do not try to pick bottoms and do not try to pick tops either. Since the down moves are often vicious and the bounces are volatile, typically we can catch them even if we miss the first move in either direction. Don't be a hero. There's no bonus award for losing money. You don't get a badge of honor if you lose money. Ranges. Currently, the S&P range is huge, right? We have 2,000, which we're right about to hit, and 1,500 being the recent bottom. It's a much bigger range than normal because this is a much crazier market than normal. It's a huge range, but if the bear market is confirmed, it's likely we will break through the downside range. A bullish move sustained above 2,000 would indicate perhaps all we got was a one-shot correction, which is very rare, and the uptrend remains intact. Again, don't be a hero. The great thing about setting ranges, if you can play them both ways, So if tomorrow we gap up again and hit S&P 2000 plus, for me it's an automatic short. If we gap down, I'd likely look for a bounce into that area anyway. Personally, I like options because if I'm wrong, I've defined my risk, and if I'm right, I can maximize the leverage of my account. Okay, so my free idea is a stock that clients know very well since we recently, in fact, we had this stock, puts on this stock, and we made about $4 in one day on it on Tuesday. SCTY, it's a top pick. For me here, it would be a perfect short to me at $50 to $52 on a gap up. Now it's off that, so it needs a few dollars more to hit it. But if it were to gap up tomorrow to the $50 area, to me, automatic short, auto. Again, we had this one with puts early in the week for fours in a few hours of trading. Now it's squeezing and fits the criteria for stocks that are heavily shorted. Had to be covered and should resume its downtrend once the market hits resistance, which in this case would be squarely at the $50 area. But I'd leg in starting tomorrow on any gap up or move higher on the stock of any kind. To give yourself some time, I like the October 16th $50 puts at $70. At $7 if you're using options. I want to move with the stock as much as possible rather than pay even larger premiums. The other way to play this is to short the stock and then sell puts against it every week. You can usually get $2-ish in premium every week, which is very attractive. I'd short 200 shares for every put I'd sell. So for example, if you shorted 1,000 shares of SCTY, I'd sell 5 SCTY at the money puts on a weekly basis and collect. It's cut off from me. Mike, can you read the rest of that? I can't read it on my screen. But the bottom line is that, to me, that's my preferred way of playing it, would be to short the stock and sell a half amount of puts at the money puts. It has to be at the money. It can't be out of the money. It has to be at the money for this to play to work. And then you keep on selling them every week. Every week. We did this with really great results with HLF last year. because it was stuck in that downtrend, and we just kept on selling that.
Mike, you want to read the rest of it?
All right.
I brought it up there.
So I think that's the bulk. Okay, so um, I think ultimately SCTY is a 20s stock at best. Just keep in mind, one of the reasons why it's such a great play, in my opinion, on this squeeze that we've had, is that this is a stock that has squeezed. It's up 20% or so off the Mondays and Tuesdays low. It has north of 50% short interest, I believe. You can double check that. So when it did squeeze, and when it does, it's going to move huge, and it has moved huge. So I think that this is a great opportunity to short a stock that, in my opinion, had no business rallying from where it was to begin with. And this is a good entry place. Now, let's see. I need the next slide, Mike. Okay, thank you. Okay, so you guys all know I have a top 10 plays for the correction in the paid class upcoming in about 20 minutes. You can also buy the paid class recording if you can't watch it right this second. You all should have the link, or you can email me, mwparness@gmail.com, and I'll send you the link to sign up for it. There's a bit of a rush. I feel strongly that we were setting up for a move back down off this bounce, and you do not want to miss the huge potential profits if I'm right. The list is of all optionable stocks. Every single one is optionable, and I'll be giving exact plays with entries and exit targets on the top 10 plays. Again, you can email me for the link if you don't have it at mwparness@gmail.com. Thank you very much, everybody, for showing up. If you guys have questions, I'll take them for the next couple minutes. And if not, we will head to the paid class in about 20, 25 minutes. Mike posted the link. I am betting against Elon Musk, yes. Just like we bet against, we had Tesla short and made good money. I don't care. Elon's got enough money. He can afford the stock to go down to $10, which is where I think ultimately it ends up at. And recently, Jim Chanos, who's a very smart short seller, hedge fund guy, gave this as a top pick for a variety of reasons. So I'm not the only one who's betting against Elon Musk. Yeah, of course hedge funds get squeezed. Look, anybody who has a heavy position one way or the other gets squeezed when the market goes against you, right? The only difference is, right, absolutely. Well, we had Soon today, so we made a fortune on that because I called it yesterday. I also called USO for oil's move today. We made 33% on the options I gave in less than 20 minutes. So, this is a market you can make some serious money in. Mike gave you the link for the chat room, the Legends of Wall Street trial. I'm now in there almost every day. I probably won't be in there tomorrow. I have stuff to do with my kids, but I will be in there next week for part of the day. I'll be in California, so I'll be trying to get up at 6 o'clock in the morning, but I intend to be in there moving forward as often as possible. And you also should check out the Option Trader, where I give anywhere from 1 to 6 or 7 option ideas every week. Lately, it's been more than it had been. So I'm trying to give a few. Thanks, Michael. And it's cheap. My thing is always, and I tell clients all the time, look, if you guys offered me a service where I know I'm going to get one good idea every week, I mean, how much do you want? I'll pay you whatever you want. If I know that that's going to hit, a high percentage, that's worth a lot of money to anybody. That service, the option trader, it's called Extreme Income Trader, is $497 per quarter. So it's very affordable. You're going to get a ton of picks, and knock on wood, like I said, I can't guarantee it, but we've been killing it. We're killing it. Michael Rosen will tell you. He's not a paid client. He's doing this at free will. We've been killing it. I mean, it's not easy to call an option trade, at 2:30 in the afternoon, and 20 minutes later it's up 33%. And it's a cheap option too. We called the USO $13 calls at 70 to 75 cents, and we took half off at $1. So that's some 35% or so in less than 20 minutes. So I urge you to sign up for the free trials, check it out, see for yourself. Obviously, not every pick is a winner. Nobody does that. If they tell you they do, they're lying. But we've been doing really well, and I hope to continue doing that. I've been doing this for 16 years now, so I'd like to think that I know a decent amount. Also, look for my new book. It's called The Art of Trend Trading, Profiting from Animal Spirits. It's coming out by Wiley in the fall, so you should all buy a copy, but I'll promote that more when it's published. Just sold it to China, so you can buy it in Chinese as well. I know you all want to buy it in Chinese. Forget about the English version. I'll be out in California next week. If anybody's out there and they want to meet and have a session with me, I'm happy to do it with them as well. Just email me at that mwparness@gmail.com. I can even come to your house and do one-on-one coaching with you. So give it a shot. Hasta la vista, baby. I'll see you in the paid class, hopefully. You should all sign up for it. We'll be back at 8 o'clock. Thank you, Jane.
Thank you, everybody. I'll see you guys in the paid class. I'll be sending out the email to everybody. Good night, everybody. Also, anybody who wants to get cheaper brokerage services, email me, Mike@affinitytrading.com. I forgot to mention that. I'm pretty sure I'll be able to save you 30% on your brokerage costs. Mike@affinitytrading.com.